I can't see the Zoom window. Can you please show me the Zoom?
Zoom is here.
Okay, perfect.
That letter Z.
Perfect. Okay.
Yes.
Hi everyone, good evening, and I hope that you're all well. Welcome to the first GTC webinar. Our webinar today will be showing you a week ahead of trending topics, themes, and what to look out for in global financial markets. Obviously, right now we're in a very exciting time. We're starting to unwind down to the final quarter of 2023. There's certainly a lot happening when it comes to uncertainty over interest rates, inflation fears, the recent shock higher in oil prices. So I'm your host and I'm delighted to do this webinar with you. I'm just going to start sharing my screen. Okay, everybody should now see my screen. Okay, so just before we begin, I'm just going to go over a brief disclaimer on our webinar material. So the general disclaimer is that over-the-counter margin derivative contracts, including contracts for differences, CFDs, and spot foreign exchange are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how these products work and whether you can afford to take the high risk of losing your money. Independent professional advice is highly recommended before investing. This webinar serves as an educational purpose only and will not include any financial recommendation or advice. Again, the content here is personal ideas, for ideas and analysis only. It's my own personal opinion. It is not investment advice. Trading carries risk. Okay, so who am I and who is the presenter? So my name is Jamil. I'm the Chief Analyst at GTC. I'm delighted to start this webinar series with you all today. In terms of my career, I've spent just over 10 years now, a decade analyzing global financial markets. The assets that I cover include world markets, which would be major stock indices, whether that's the S&P 500, the NASDAQ, or the indices in Europe, such as the DAX, the United Kingdom, the FTSE. That's what I mean by world markets. Foreign exchange, emerging markets, gold, oil, and Bitcoin. My personal expertise is in fundamental analysis, global macrofinancial issues, and geopolitics. So by geopolitics, I'm referring to the political risk elements of how that can impact financial markets, whether those are spectacular events such as Brexit, or maybe some of the more uncertain political events of recent times. We include the former US president, or some of the other events that are happening in the world. And when I talk about global macro financial issues, I'm talking about the recent spike higher in inflation, uncertainty with interest rates. We're certainly at a much different period now in financial market sentiment. And I would say that the era of how we trade and how the market's performing is also different, because when I started my career, it was the aftermath of the global financial crisis. We had this aura an era of low interest rate policy. And that period continued for a number of years, all the way up into the late 2010s, all the way up until 2020, which is actually when the pandemic hit. Unfortunately, following the pandemic, we've now had another shock, which has led to higher oil prices, inflation, food prices, and so on and so on. We all know that wherever we sit right now, there's challenges when it comes to the world economy and financial markets. So I'd say that if you're trading now and you were trading 15 years ago, those paradigms are completely different, and those parameters also. So that's what I'm going to talk to you a little bit about today, how the market's changing, how the sentiment's changing, even how I do my analysis, how that's changed as well. What are we going to learn today, and what are we going to do? So we are going to discuss what to expect in financial markets this week. We're going to take a look at the economic calendar, the events that are going to come out, what data releases we're going to watch out for. Also, we're going to talk about the current trends taking place in global markets, whether that's the oil price hitting its highest level since November of last year, the euro hitting its lowest level since early 2023, just a couple of days ago. We'll look at these other different asset classes overall. We're then going to take a look at the charts and some potential trading ideas and opportunities. Again, this is not trading advice, it's not investment advice, it's just my own personal views on where certain assets might be heading. This week is another important week for global financial markets. There are a number of Tier 1 economic data releases, not limited to numerous central bank decisions, whether that's the Bank of England, the Swiss National Bank, the Bank of Japan, or of course the US Federal Reserve. There's also a number of PMI data releases, inflation reports from both the UK and the European Union, which also run into effect with the central bank decisions based on what the central banks are looking out for now. So let's quickly take a quick look on what to expect over the coming weeks. We're at the end of the day today, which is Monday, so obviously we're going to start taking a look at Tuesday. I've taken all the data from FX Street. I generally take the economic calendars either from FX Street, Profit.com, or I take it from Forex Factory. Investing.com is another one. So if we look at tomorrow, what we're expecting in financial markets, in the morning, we're going to have the RBA meeting minutes, which is the Reserve Bank of Australia. We're going to come to that early on Tuesday morning. The main report that we're looking out for on Tuesday is actually the inflation data that comes out from Europe, which is very timely following the European Central Bank raising interest rates last week in Europe to the highest level since the euro was formed in the early 2000s. And I think we have to look at the euro and the European inflation data as an event risk, mainly because if you look at the comments that came from the ECB on Thursday, they're worried that inflation will stay too high for too long. However, if you check the economic data, the main data, whether that's the PMI indicators or some of the other announcements, we can already see that the European economy is tanking, falling flat based on high interest rate policy. At the same point, the European Central Bank are stuck between a rock and a hard place because they need to raise interest rates based on inflation. That's why this recent shock higher in oil price over the past week is a big concern for the likes of the euro and the British pound, and we'll talk about that in just a couple of moments. Later on Tuesday, we also have some other data, some housing stats from the US and data from Canada, but generally what we're going to start looking towards is Wednesday morning. We have the PBOC, the People's Bank of China, scheduled to have the interest rate decision. We know we have a lot of concerns about currency devaluation and currency weakness coming from the side of the Chinese yuan right now. That's another event we have to look for. But I would say that's an event to kind of set the tone for what we might expect in terms of the dollar over Q4. But over the near term, we have to look more towards our other data releases, specifically the Consumer Price Index, which is the inflation data for the United Kingdom. And I would say that's the main event for Wednesday, apart from, of course, the Federal Reserve interest rate decision on Wednesday evening. We're going to take a big deep and dive into detail later in this session. Thursday will be dominated by the aftermath of the US Central Bank decision the night before. as well as the Bank of England interest rate decision. The week will not conclude there, because on Friday morning we have the Bank of Japan interest rate decision. We'll speak about it in a couple of slides, but the Bank of Japan is specifically concerned right now about Japanese yen weakness and whether they might use this meeting as an opportunity to try and bounce some strength back into the yen. We'll talk about that in just a few moments. So let's take a look at the Bank of England meeting. On Thursday, the Bank of England are widely expected to raise UK interest rates. The risk to traders here, with the British pound US dollar already trading at its lowest levels in just over 3 months, is that the economic challenges in the United Kingdom and European Union are very similar. Of course, the Bank of England and the ECB, the European Central Bank, are completely independent. However, the challenges that they face when it comes to inflation expectations, persistent weak economic growth, underwhelming economic data are very similar. So I see a risk of the Bank of England on Thursday morning repeating the same message from the European Central Bank at the end of last week, where they warned that inflation is going to stay too high for too long. This sends signals to the market that we can expect the British pound to remain weak. Why, Jamil? Why is that? Why fundamentally is that? Because if you look at the structure of the UK economy, the Bank of England have already raised interest rates to a point that they haven't been in decades. The UK economy is also structured in a way with the housing market. If you are a homeowner, typically you have a mortgage term of 2 to 5 years. Those are the most popular and common. Also, what's most widely available in the retail banking sector when you're going to apply for a mortgage. If interest rates continue to go up, and they've already gone up aggressively over the past 1 year, unfortunately, those homeowners are at risk of no longer being able to pay their mortgage. Even more specifically, they're at risk of not being able to spend any more money within the UK economy, whether that's going out for shopping, hospitality, traveling within the UK, or day-to-day activities. They're going to have to start reining back. This is a big concern for the Bank of England right now, which is why even if they did raise interest rates, there is an awareness in financial markets that there's only so much further that the Bank of England can go when it comes to stretching towards higher UK interest rate policy, which suggests that the pound will remain weak because it pushes us towards the safety of the US dollar, and we're going to cover this in a few moments. If we look at the pound US dollar overall, it currently trades close to 3-month lows. And what I find particularly exciting about the pound US dollar right now, if you look on the daily time frame, we actually have a head and shoulders pattern that formed over recent weeks, and that neckline has broke straight through in September. We can already see from our decline here, from our neckline, how much further the pound has fallen. And unfortunately for those like myself who might want the British pound to strengthen, I'm actually British, it's unlikely because of the economic situation. And this is one of those circumstances where both the fundamentals and the technicals come together, and there's an opportunity to see weakness in the British pound. This is also not helped by how bullish and upbeat the market is on US dollars. Everybody right now wants to carry the safety of the US currency. So if you're going to ask me what potentially could happen with the British pound, I think it's likely that we're going to see more lows. Economically, we can certainly see more lows. The technical pattern on our head and shoulders suggests that we can still fall further. However, if you look at where my mouse is here in our candlesticks, we do see the potential of a double bottom. A double bottom might suggest a near-term price reversal. Again, it would be considered as a risk. Nothing's for sure ever in financial markets. but the outlook is more likely that we're going to see further declines in the pound than we're going to see it recover, unless the dollar weakens following the Fed decision. Why do I talk about double bottoms and why it's important? If we look on our euro dollar chart here, we can see 2 daily double bottoms on our daily time frame, specifically here, which led to a big rebound in price. We also interestingly have a double bottom that's forming here, which could suggest that that the pair euro dollar has been heavily oversold and it's due a price reversal. I agree. Major FX pairs, gold, all assets that are denominated in US dollars are due a potential recovery. But that recovery is not guaranteed, and that recovery is still a risk because of the way the market is behaving. So you might say to me, Jamil, what is the double bottom? Please explain us more about this technical analysis pattern that you just explained, just like the head and shoulders pattern on the pound US dollar. So what is a double bottom price pattern? The double top and bottom price pattern is one of the most popular reversal price patterns in technical analysis. It is very popular among traders, not only because it's fairly simple, but because it can be applied to all market segments and time intervals. Double tops and bottoms are one of the most popular price patterns in technical analysis. They are reversal price patterns, which means that they indicate when a trend might reverse. And that's the key term here. It might reverse. I'm not so sure based on the economic and the fundamental picture. That's why even though we have the double bottom that's forming on our pound US dollar, I've gone back to our previous slides, I think that the risks to the pound are more significantly weighed to the downside than the upside. So sure, the pair looks oversold. It looks like it's due some recovery, but the economic and fundamental picture is very concerning. At the same point, the market is so bullish and upbeat on the US dollar. So when it comes to the Bank of England and the meeting, I'm concerned or somewhat anxious whether we might see a similar reaction to the European Central Bank. We all watched the European Central Bank meeting on Thursday afternoon, where the euro was sold off significantly, more than 100 pips, despite the European Central Bank raising EU interest rates. Let's now go back to our other slides and what we just talked about. The economic challenges when it comes to inflation and when it comes to what's happening in the world, data, oil price shocks, all very similar. Now, we already know that the European Central Bank warned that inflation is set to remain too high for too long. What if the Bank of England repeated a similar message this week? From a fundamental perspective, this would suggest more weakness, more weak momentum, more negative potential selling momentum in the British pound, which is why I'm not too optimistic about the double bottom that we've seen form on our daily candlesticks here. In fact, I'm more of the opinion that we have further to fall from our neckline if we follow the heads and shoulders pattern. We've already seen that since we drew out our neckline, we started watching this pattern a few weeks ago, the pound US dollar has fallen just over another 200 pips. I do think that if you follow some patterns like technical analysis, the heads and shoulders, and then if you combine the fundamental picture, it provides more of a conviction on why to be weak sentiment, weak momentum on this pair. Going back to the euro dollar, one other trend that I would like to show you, apart from the double bottom, is how clean this downtrend has been. Why is the downtrend important? Because I'm going to show the uptrend in oil later in this presentation. We have lower highs and lower lows on consecutive candlesticks. More than 2 successive lower highs and lower lows signals a downtrend. And we can see since these candlesticks formed, how much further the euro dollar had to fall. Again, the pair might have bottomed out here. The double bottom does look like a strong pattern. However, if the market wants to buy US dollars and if it has impetus and aspiration to be more long buying the greenback, then this is a big risk for pairs like the euro dollar, which is why despite all of the strength we've seen in the US dollar over 2023, it would not surprise me if we see some more strength headed into the final quarter of 2023 as well. Before we go on to the Fed and the US Central Bank, one other meeting that we need to talk about is the Bank of Japan. On Friday morning, the Bank of Japan will set its own monetary policy. Why is this particularly timely? Because it was only early last week, exactly 1 week ago, that the Bank of Japan governor made an unexpectedly hawkish comment regarding interest rate policy in Japan. But more importantly, we know that the Japanese central bank are very concerned about currency weakness. We've seen the yen weaken a lot over the past couple of trading sessions. What if it's more verbal intervention and the Bank of Japan just trying to intervene verbally to try and strengthen the currency, which is a little bit of game to play with traders that doesn't always end up working well, but it does signal to the market what levels the Bank of Japan are potentially uncomfortable with the yen, and we're going to show that in our next slide. But considering the Bank of Japan and the Japanese yen, what we do need to remember is Japanese yen pairs are always up there for favorites when it comes to traders. So pairs like the euro yen, the pound yen, the Aussie yen, these are all pairs that we can watch. Now, speaking of trends and uptrends, we have a clear uptrend in the dollar yen, the USD JPY. This is the daily time frame. If we look on our candlesticks, we have successive higher highs and higher lows. Higher highs, higher lows. And it keeps continuing and continuing. However, we just spoke about the Bank of Japan showing some distress with yen weakness. And there is a particular area, roughly between 148 and 150, where it is thought that the Bank of Japan will not hesitate to intervene in financial markets to buy yen and sell US dollars. If we look on where our candlesticks are forming right now, we are getting dangerously close to this level. So this means a couple of different things. Number one, institutional and professional traders might find encouragement to take profit on the yen around these levels. That can be considered as a risk management approach because of concern over the Bank of Japan potentially intervening in the market. And if we look at the last time the Japanese yen was weakened to this point against the dollar, we did see a significant pullback in price. This is around the time that yen Bank of Japan speculation started to pick up speed, but it's become more apparent over the past couple of trading weeks and months. So what could the Bank of Japan do? This is the one central bank that has not raised interest rates despite of global concerns, despite inflation, and despite high interest rate policy. They've still kept policy very much unchanged, specifically compared to its peers, whether that's the US Central Bank or the Bank of England or the European Central Bank. And now the Bank of Japan is starting to talk about higher interest rate policy. However, the key thing to take away is we're seeing these comments come out around the same time the yen is trading around what we could call the Bank of Japan distress zone. So this is where we could potentially look for some opportunities to gain some momentum on the side of the yen, which is why we talk about all of the Japanese yen pairs here. I think it's very clear that the most popular one is the dollar yen because of the major. However, we shouldn't forget that the pound yen, the euro yen are some of the most liquid and active currency pairs around, and they're volatile. What do I mean by volatile? They move a lot. But we also need to apply risk management, which is why we need to be aware of what's happening in the market. We need to have a knowledge of technical analysis and also fundamental analysis. This is why we should also always consider having a stop loss if we are going to trade. I'm not suggesting that we do, but it's important to have risk management protocols in place. The main event of the week is very much going to be the US Federal Reserve interest rate decision on Wednesday evening, Dubai time, Wednesday early day in America. Why is this decision important? I would say it's because the market is not pricing in either an upbeat or a downbeat Federal Reserve statement. If we look at the economy, it continues to show resilience. Very strong United States economy, despite all and any global economic challenges. We spoke about the challenges in Europe, the United Kingdom. The US faces the same challenges, but the data is performing with resilience. As such, one trade that is picking up speed and picking up a lot of momentum, has been spoken about a lot, is the economic divergence trade, where investors are buying dollars based on the US economy performing better than its peers alone, irrespective of central bank policy. We saw that specifically in the aftermath of the European Central Bank decision on Thursday, where the dollar index reached its highest level since roughly early 2023. That was just based on the market selling euros and wanting the safety of the US dollar. If we look at technical analysis on the dollar index, actually it's possible that the greenback, the US currency, can still get stronger, which is a huge concern for global assets because we already have a euro that's close to its lowest levels ever. We have a pound US dollar that's still at lows that's not been seen in roughly a generation. Many emerging markets and their currencies are suffering to degrees that they've never known before based on currency weakness. And it's a big problem for inflation because what are all products priced in? Dollars. So it's like being hit twice. You've got economic challenges, but then you're having to import a higher oil price that's denominated in US dollars, which is making the inflation problem much worse. However, the US economy is not showing similar weaknesses to others. So, if we were to look at a few possible clues, what can we monitor and look for clues ahead of the US Federal Reserve meeting? It could be argued that a downbeat Fed message has been priced in. So if the Fed were to say, and it's unlikely they will, interest rate policy in the US has reached its limit, we need to hold on interest rate increases for the immediate future and not change policy, that hasn't been priced in. But for those who are bullish, they want to buy the euro dollar, they want to buy the pound dollar, they want to buy gold, they want to buy world markets, that would be seen as an opportunity. However, considering our first point, the economic resilience, and that the data still remains strong, what if the Fed looked at the most recent shock higher in the oil price, where oil reached $90 for its first time since November 2022, as an opportunity to indicate that future US interest rate increases are still possible? This can encourage another round of significant US dollar strength, which other economies cannot handle, but financial markets are not human. If the market wants to buy US dollars, the dollar is going to go up. And both the fundamental and the technical analysis perspectives suggest that the US dollar can get stronger as we go towards the final quarter of 2023. Let's now take a look at a few different charts. Let's start with gold. Okay, so you can see on my screen, again, we have clear, more downtrends. Lower highs, lower lows, lower highs, lower lows. And we can see that how much gold prices have fallen in recent weeks, ever since hitting that 2,000 milestone level about 4 months ago. For those who remain bullish on gold, most of the consensus and the reliance is on economic challenges remaining for a long time. From that perspective, it's valid, because if we were going to enter an economic downturn, and it does appear that we are, the challenge with this downturn is not how bad the downturn will be, but how long the economic downturn can last. And this is what I keep saying in media interviews and when speaking to colleagues and industry peers, that the problems of 2023 are completely different to the problems of 2007, the global financial crisis. Although we see some similarities in terms of the economic distress, the core issues are different. One of the challenges here is that everything about this environment suggests that the US dollar can remain strong all the way into next year. It can remain strong until the point where the Federal Reserve, the US Central Bank, say, guys, we've reached a limit. We cannot move interest rate policy any higher. We now need to consider cutting interest rates. That would be seen from a fundamental perspective as the bearish selling potential signal. However, the data shows that no matter how much we thought that might happen in the second half of 2023, it has not bared fruit. And we always say that the devil's in the detail as well. And the details very much show strength in the US economy. So one question I've been asked quite a bit is, can gold prices recover? I think you can see my screen and my mouse. Yes, they can recover, but the upside is limited. If we look at gold prices currently trading around 1930, I would say that the upside is limited to maybe 10 to 20 more dollars. However, if we have another significant round of US dollar strength, we can see gold prices crash even more than we've seen over the past couple of months. In fact, I would say that this current candlestick here, which does suggest a reversal, and it did see a low of around $1,900, I'm not confident that that's a stable floor. I don't think that this is a floor for gold prices by any means. But I do think that a potential ceiling for gold prices is around 1950. To be longer term bullish on gold and to think that gold prices could do better over the longer term, we need the signal from the Federal Reserve. And we are not getting that signal that they are going to cut interest rates. As such, we're not getting the signal that the US dollar is going to weaken. And consequently, we're then not getting the signal that gold prices can benefit. Everybody's waiting and wants a weaker US dollar, whether you're buying the euro, you're buying the pound, you're buying commodities, precious metals, world stock indices. You all want the downbeat message and the narrative from the Federal Reserve, the US Central Bank. But it doesn't mean we're going to get it. And if we do get it, it could be a long time. So, to sum up on gold, the upside appears limited. Maybe we can see an up to another $10 to $15 in the US gold price, but the downside could be significantly more. And one thing we do say in financial markets, it's always the risk that hasn't been priced in, which is the risk that you need to watch. And I would say is the downside uncertainty, the lack of a support or potential another floor in prices, which is why we need to be careful about longer term buying gold, unless we get that statement and that signal from the Federal Reserve. But we've been waiting for such moments for a number of months, and we're not getting there. Another problem and another reason why the market is even more bullish and optimistic on the US dollar is the shock higher in US oil price. The US oil price has reached its highest level since November 2022, and this uptrend is beautiful. Consistent higher highs, higher lows, higher highs, higher lows, and it just continued. I think that the market is now accustoming to the fact that political forces are at play when it comes to oil price, specifically with OPEC and OPEC Plus, and they are very clear that they want oil prices to remain higher for longer. Irrespective of any difficulties this provides to other currencies and economies, which is what we will talk about in just a few moments, because that's another reason to be bearish on pairs like the euro dollar or the pound US dollar. But if we look at the oil price, again, higher highs, higher lows, no end in sight. Yes, this commodity looks exhausted. It looks like it's due for a pullback. But when political forces are at play with OPEC and OPEC Plus, it is a big risk to take profit on the oil price. Which is why maybe we could see some retracement, some taking profit, but to sell oil, considering the uptrend, considering the fundamentals with the economic and political noise, is a huge risk to take in your portfolio, especially when it's becoming clear that oil producers are stubbornly optimistic and committed towards maintaining a higher oil price for longer. And this has reminded me of one thing. This oil price shock makes inflation, and it makes the problems for the EU and the UK economy even more of a headache than they already were. Because the oil price shock basically means that inflation risks will remain persistently high. Even if someone says it's just paying at the pumps when you're filling up your car, it goes deeper than this. It basically stops inflation flatlining, and even if we have a consolidation, we're going to see a likely another increase over the final months of 2023, which is going to encourage more suspicions that central banks have nothing that they can do in terms of they can't raise interest rates anymore. The economy is already at risk of a recession. The consumer is at risk to not being able to pay their mortgage because borrowing costs are too high. So what does that suggest? That suggests another fundamental reason to be pessimistic and to have a negative view on currencies like the pound, the US dollar, and the euro, but to be bullish on the US dollar. So just before we go on to our questions and we conclude our first webinar, let's take another look on what to expect over the coming days. Tuesday, do not forget the EU inflation report. Following some housing data from the United States later on Tuesday. However, the inflation report will be considered as a tier 1 event risk, especially following the ECB interest rate decision last week, which sent the euro to its lowest levels in months. Also will be noteworthy what the Reserve Bank of Australia think about current global economic landscape. Tomorrow, as in Wednesday, the day after Tuesday, we'll see UK inflation and the People's Bank of China interest rate decision is scheduled. The UK inflation is likely to seal the deal that the Bank of England will need to raise interest rates on Thursday, which could also mean more volatility in the pound. Myself, I'm clear, I'm negative on the currency. Thursday, well, before Thursday, on Wednesday evening, we've got the Federal Reserve interest rate decision from the United States. Thursday, the Bank of England interest rate decision, the Swiss National Bank interest rate decision, and actually I do want to talk about the Swiss National Bank decision because we've seen such a downtrend in the euro over the past couple of months. Let's not forget that the main exporter and trading nation of Switzerland is Europe. So if the euro is weak, and it's set to remain weak for the foreseeable future, it does give reason for the Swiss National Bank to try and weaken their currency. The week will then conclude on Friday with retail sales in the UK. Very busy week for the UK after all, but the Bank of Japan interest rate decision. Okay, before I go on to our questions, before we conclude our webinar, just to remind you that this coming Thursday, we do have another webinar. This one is due to popular demand and request on the BRICS. To give you a little bit of insight towards what I'm going to be discussing, in recent weeks, specifically following the BRICS Summit conference in Johannesburg last month, we saw a number of different nations have unofficially been confirmed to join the BRICS in the near future. This has created a lot of speculation over the outcome it might have on the US dollar, what it might mean to the US dollar's role as the world reserve currency. I have my own views on all these subjects, and this is what I'm going to be sharing on Thursday with you all. You can register for our next webinar on this link. And by clicking on this webinar link, it comes to the webinar page. And then click on register. In terms of some of the topics that we'll cover on the webinar on Thursday, we're going to discuss the BRICS in general and what the BRICS is, what it means, how important it is to the world economy. We're also going to talk about economic power and political power, because the increase in the BRICS is more about political power and shifting some of the dominance away from the US rather than financial power. in terms of markets. They're two different worlds completely, and I'm going to provide some more insight behind that. So we're going to look at the role of the US dollar in foreign exchange markets. Why expanding the BRICS is seen as a threat to the Western world, and specifically US dominance, again, political power. Why expanding the BRICS might lead to a less strong relationship between the US dollar and oil. Again, I spoke about in recent slides about oil being very much driven by political news and the agenda of OPEC and OPEC+. Several of those members are going to be joining the BRICS committee, where you have huge commodity importers such as China and India, which have their own motors behind where the oil price is. We're then going to look at what would need to happen for the world to become less reliant on the US dollar. Just as a quick snapshot, the US dollar still accounts for more than 90% of all Forex FX transactions and trades. One subject that has been raised is why a BRICS currency might be able to challenge the US dollar. In my view, it will not be able to challenge the US dollar at all. And then I'm going to decipher what the BRICS currency is and why it would not be able to challenge even if one was formed. Okay, guys, thank you very much for your time today. I hope you've enjoyed this week ahead webinar. We've looked at a few different themes in global financial markets, a few different aspects of what we need to monitor over the week ahead, some trends, some potential trading opportunities. If you have any questions, you're more than welcome to ask them. You can also get in touch via GTC's social media channels following this webinar, and I'm more than happy to answer them. Does anybody have any questions? Okay, so just to recap then. This webinar looked at a week ahead in financial markets, themes and trends to monitor. However, all of the content is and was my own personal views on financial markets. This webinar was just for educational purposes. It did not include any investment advice or trading advice. Trading is risky and it carries risk. So please do take note of this. Thank you very much for watching. Thank you for your time. And I look forward to seeing you on Thursday for our webinar on the BRICS. Thank you.